Hi guys, this is Yao. I'm starting a video series to share my trading and investing process. My process involves 4 steps here. The first step is to identify and analyze the market risk, followed by performing probabilistic analysis. And my third step is doing technical analysis. And finally, I wrap it up with performing fundamental analysis. Now in this video, we will only talk about identifying market risks because each topic on its own is relatively lengthy by themselves. So it's going to take a few videos to really complete my explanation. With this said, let me show you how to analyze the market. Okay, so to identify market risks, I use Bloomberg News, and what I usually do is I go to the market section. Let this load up, and this section contains all the news related to the stock market. On the top, you have stock indices like DJI and the S&P 500. Now DJI stands for Dow Jones Industrial Average. Both DJI and the S&P 500 are market indices. A market index is a measurement of how the stock market is performing, and it contains a basket of stocks. The S&P 500 is the most representative market index because it contains large cap stocks from many different sectors. Large cap stocks are stocks of large companies like Apple, Google, Microsoft, Starbucks, and more. When the S&P 500 goes down, it means that a lot of stocks will go down as well, even if a particular stock is undervalued. And this is why you need to know whether the stock market is on a downwards trend or on an upwards trend. Okay, let's get started by how I analyze the news. Here's what I usually do. Every morning and evening, I'll go through the headlines, like this one here. For example, US stock halt, 5-day skid, Brexit Royce pound. This is not really that useful, so I continue just skimming through the headlines. You don't really have to read the articles themselves. What is more important is you want to get a very general picture of how the entire economy and market is doing. So I would usually just skim through all of this, trying to understand what is happening here. So sometimes I also watch the videos, and I will come back to the videos a bit later. I have a point to make there. And news here as well. They are also related to the market. These are some news for crypto traders. If you're a crypto trader, I'm not. So let me go back up, and I want to talk about a few things that I generally look out for. I have 4 categories of keywords that I usually try to look up for, and they are as follows. The first type of keywords are related to economy growth. The second type of keyword is related to inflation. The third type of keyword is related to interest rate, and the fourth type of keyword is a geopolitical event. So as you can see here, this headline here says that Jamie Dimon is the CEO of JP Morgan, says that growth is strong, but recession is possible by 2020. So he's saying that he believes the economy is strong, but he sees a possible recession by 2020. So these are things that you want to look out for. These are all signs to tell you that economy growth is slowing down, because to hit a recession, you have to have the economy growth slowing down and then eventually turning negative briefly. So let me see if I can find one that is related to inflation. I don't think there's one related to inflation here today, unfortunately. Interest rate, let's see if there's anything related to interest rate. I don't see anything related to interest rate as well, unfortunately. Well, usually you will see a few more things like Federal Reserve and stuff like that. Those are all related to interest rate. So let me expand a bit onto the 4 type of keywords that I've just talked about. So with economy growth related keywords, you want to get the sense of whether the economy is growing faster or slowing down. If the economy is growing slower, the stock market is more likely to go down, and vice versa. In October 2018, which is not far away from when I created this video, the stock market has fallen roughly about 10% from its top. The main reason is the economy is growing slower, and many tech names display weaknesses in their guidance. The high valuation of the stock market requires an accelerating growth to sustain it. Unfortunately, when the economy growth slows, this translates into slower earning growth, which causes the stock prices to go down, because this is due to mean reversion and stuff like that. So the lesson here is always keep an eye for news that points to slower economy growth. The second type of keywords is related to inflation. And accelerating inflation is bad for the economy because it increases costs for companies and it pushes the Federal Reserve to make interest rate hike faster. Increasing costs will decrease company earnings and therefore causing a sell-off in the stock market. So remember this, Wall Street only cares about earning or profit growth. If a company profit or earning growth slows down, it has a high probability that the stock price will go down as well. So faster inflation would cause stock market to go down. It may not be immediate, but eventually it could cause the stock market to go down. So the third type of keyword is related to interest rate. A higher interest rate may not always result in a drop in the stock market, but if the interest rate hike suddenly becomes faster, then there's a good chance that the market will drop. Conversely, if the interest rate hike suddenly slows down, then there's a good chance that the market will go up momentarily. This is the result from analysts trying to calculate prices based on the discounted cash flow. Due to time limitation, I cannot go into the details about discounted cash flow, but I suggest you to Google it. To give you a rough idea though, according to the discounted cash flow formula, a faster pace in interest rate hike while earning growth stays the same would decrease the present value of stocks. So this pushes down the stock market. So to summarize, faster interest rate hikes make the prices of stocks go down, while lower interest rate will eventually help to push the market higher. The last keyword category is geopolitical event. You want to look out for words like war, government shutdown, election, just to name a few. Usually the impact from geopolitical events are not a big deal and they usually subside relatively quickly. So those could be good entry points if the prices drop enough, or drops a lot. You might want to consider to buy some when they are really low. So that's all I have for the geopolitical events. So to summarize, there are 4 important types of keywords. Number 1, economy growth related. Number 2, inflation related. Number 3, interest rate hike related. And the 4th type is geopolitical events. Before I end this video, I want to point out that the videos on this page has a lot of analysts going up there and expressing their viewpoints and their opinion. What I recommend you to do is not to take their opinion about market trend or stock trend too seriously. However, what you should pay attention to is their reasoning for their opinions, because sometimes their reasonings could be correct, could be incorrect, and that's ultimately what's going to is going to help you or destroy you, right? So those reasonings are typically related to opportunity and risk. I would recommend to write down or remember those opportunity and risk that they have just talked about. Then you want to make your own judgment on those opportunity and risk. You can also consider talking to a few friends, but be careful that your friends have certain biases, because they might own the stock or they don't like a certain company and so forth. In particular, you want to use the risk to discount the amount of return you can make. With opportunities, it gives you more confidence that it will hit a particular price point if you have a price point in mind. But don't assume that you can make more profit or believe that it's a 100% chance of making money. Unfortunately, there's no 100% chance. So to summarize my thought on analysts, don't take their opinions on trend too seriously, but listen to their reasoning on opportunity and risk. So that's all I have for market risk. If you are a beginner and you want to learn more about different risks for stocks and bonds, consider taking a free online course that I have created. There's no credit card needed. It is called Learning Investing Basics in 2 hours. I'm posting the link in the description section below. To end this video, let me do a quick summarization. To summarize this video, we have talked about stock indices, keywords to look out for, and how to listen to analysts. I hope you get to learn and apply some of the methods that I've shared. Hopefully this will help you to be a more successful trader or investor. So take care guys, and exercise caution in this volatile market. I'll see you next time on my video on probabilistic analysis.